sign off so that people can
Why?
this live chat. Yeah, how
What?
Oh,
Hey, the YouTube, the one, it will be there, or it's just for live, or it will stay as a history can find map one?
hello, it's live. Why is it live? Can I?
No, I mean,
No.
hey, the YouTube now is live.
Mm.
In my case. I mean, it will stay as a history there, or will it not? Can.
Can don't test people
Sorry?
with issue.
Huh?
Can
Where's Ken? Left already. Where's Ken? Is she here? Is he here? He should be here. I saw three people.
no live stream.
Chat over text. Hmm. Very good evening to everyone. Let me just share my slide first. Yeah, sorry. Give me a sec. Hey. Right, the slide is up. All right, welcome everyone. This is our first webinar series for the ASEAN Investment Challenge 2025. Excited to have all of you guys joining us here. I think we have participants from various countries from Malaysia, Singapore, Indonesia, Thailand, and then Philippines as well. So we actually live streaming this onto YouTube from Zoom. So I will have to check some of your replies later on the YouTube there. So I wanted to start with some questions later, but before that, let me just. All right, so today's our topic will be on what they didn't teach you about money, or basically what they didn't teach us about money. And the idea is really that there are quite a few things that we need to set our perspective right about money before we start talking about investment. So a lot of people think about investment as something for the rich, but it's not about being rich to invest, but it's about investing in order to get rich and build your wealth. All right. My name is Billy To. I'm the regional head of retail research. I've been in the investment industry for more than 10 years. So I've been covering markets like Thailand, Philippines, back when I was an economist in RHB. I've also looked at in the stock markets in Singapore, Malaysia, as well as the US market. So probably the one that I'm less familiar with is probably with Indonesia. So yeah, so that's a bit about me. Okay, so just a disclaimer. So this is basically not an investment advice. It's basically an education series intended to help you guys to understand more about investing. All right, as well as to help you guys to kickstart your ASEAN Investment Challenge. All right, just a bit of pulse check. Basically, I just wanted to get to know our participants here. So feel free to type in the comments into the chat. All right, just wanted to know how many of you have started investing? And if you have not investing, what's stopping you from doing so, right? So feel free to just type in your answers in the chat. I'll look at it at the end or somewhere mid in of the discussions later. Right, just feel free to just put in any comments or any questions that you have in the chat box there. And let's be honest, what's your relationship with money? I think a lot of people don't really embrace this part and look at money as something that is very foreign. Some people avoid talking about it, avoid understanding about it. Some people basically just want to save money, right? Of course, there are those who just spend the money, huh? And then, of course, there are those who want to invest but not sure how to do so. And there are those who already started investing and building their wealth. So just let me know what kind of person you are. If you have any comments on your investment experiences, feel free to put it in the chat box there. All right, just a few things about the money myths that we all grew up with. I think as we all were growing up, especially a lot of you are in your uni days, I'm sure you have heard a lot of advice, which are good advice to be honest, but it's just the partial truth of what reality is, right? A lot of people talk about work hard, save money, and you'll be rich, right? Some of these are really fallacy that you will only find out when you come out to the working world. So some people think of investing as only for the rich or those who have extra money. Then, of course, there are those who think that talking about money shows that you are someone who is rude or greedy, or someone who's just always looking at money, right? Or some of you are just worried about spending and just wanted to save and spend less. Or maybe some of you see stock market as something that's evil, something that's equivalent to gambling. Or maybe some of you see stock market as a get rich quick scheme, right? Or maybe some of you look at money as the root of all evil. So there are various types of myths that we all grow up with. So just feel free to just put in some of your perspective about what you think money is at the chat box. All right, to kickstart this topic, I think the first thing we need to talk about is inflation, which is the silent thief. And I think a lot of us don't really realize this. I'm going to talk about this from a perspective by showing you guys some of the data and stats, and also bring it down to a level that you guys can relate to, right? The first thing is, if you look at the data here, this is basically Pac-Man. So inflation is really eating up our savings rate, just like how the game, when you are the Pac-Man, you're eating up all the monsters. And if you look at inflation, this is basically the average inflation rate of ASEAN countries. I'm looking at just ASEAN, Malaysia, Indonesia, Thailand, Philippines, and Vietnam. So just these 6 countries, and you can see the inflation average is about 2.9%. This is over the last 5 to 10 years. And then saving rates is only about 2.1%. So it's actually at a negative real rate. So if you're putting your money into your bank account today, you're actually losing out to some of the things that, that when inflation things are getting more expensive next year or 2 years down the road, those things you're actually losing some of the values of your money. Now, to let you understand how it affects you, let's just look at the Starbucks Latte Index, all right? So there is no Starbucks Latte Index, by the way. I call it myself, by the way. It's just data that I compiled from these countries that you guys are in, Malaysia, Singapore, Thailand, Indonesia, Philippines. These are compiled from Finance Starbucks Index, Menu Prices, Malay.com, and some other sources as well. So this is basically based on the latte price of Starbucks, the tall size, back in 2015 and 2025. Back in 2015, Malaysia, the pricing was around 9 ringgit. Today, it's at 16 ringgit. So if you look at the annual increase, it's about 5.9%. Singapore, about $5.5, and today it's about $7.7. Thailand is 95 baht, and then today it's about 145 baht. And then Indonesia is from 30,000 rupiah to 55,000 rupiah. Philippines, you can see, is from 125 to 230. So you can see that the increase in terms of pricing differ a little bit. All right, it has to do with the increase in cost, it has to do with inflation, it has to do with manpower, labor, and a lot of other things. But basically what you're saying is that your latte becomes more expensive across the region. So if you're just putting your money into your fixed deposit today, you'll probably be having less Starbucks or latte. And bear in mind some of the sizes changes as well, right? For some of the food item. Another example that I can give you guys is probably McDonald's. So this is a McD burger set. This is basically based on the Big Mac index that they have. So that is done on, I think, across certain countries. So some of these are direct reflection of the actual price. Some of it is from the conversion of the dollar to the country-specific currency. So you can see that Malaysia has an increase in terms of annual inflation rate for McDonald's at about 6.1%. Singapore, an increase of about 2.8%. This is annual increase. I mean, every year it increased about that amount of level. So Thailand, it increased about 1.3%. Indonesia is about 1.5%. So you can see Thailand and Indonesia probably is lesser in terms of that. But if you look at across the region as a whole, you can see that the McD Burger Set Index itself shows that prices across ASEAN has risen by an average of 3.1%, outpacing the average savings rate that you gain from putting your money into a bank account. Now, savings can't keep up with inflation. So this really just tells us this, right? Across ASEAN, you can see just now, right? The savings interest rate is around 2.1%. Of course, I know that when sometimes there are FD promotions, the rate could be higher. But on average, you're seeing that it's actually lower, and this could lead to an erosion in the value of your savings over time. And everyday prices are rising faster than your savings. And the inflation headline numbers that we are looking at, the data stats from the government numbers are based on the compilation of a variety of items. But if you look at everyday prices, for example, if you are staying in urban city areas, if you drink coffee, if you buy coffee from Starbucks or your cafe, your local cafe shops, so usually those prices will probably increase a little bit faster than the headline inflation numbers. So what this means is that, let's take as an example in Malaysia, right? If you're putting your savings rate at about 2%, your latte inflation is about 5 to 6% every year. So what you need to do is basically you need to save 3 times more in order to keep up with just your coffee. All right, and bear in mind, we're just talking about coffee. We have not talked about every other items, right? Okay. So now with this mindset, I just wanted you guys to know that the way to build wealth is really not about putting your money just into FD and enjoying that luxury of security, right? I'm not saying savings are bad, just that it gives you that luxury of safety, but it doesn't mean that it gives you an illusion of safety, but it doesn't mean that the value of your money is the same 5 or 10 years down the road. So what you need to do is you need to build your wealth through investment, right? So the next topic I'll talk about more on what investment is, right? So, but before we touch on that, let's just look a bit on the differences between savings and investing. So like I talk about illusion, basically savings helps to protect your money, right? You don't really lose your money, right? A lot of times when you put your savings into bank, right, there is a certain guarantee by the government. Of course, there's up to a certain limit. Different countries have a different regulation on that front. So in a way, your money is a bit more secure. But investing helps you to grow it. So the difference in two is very simple. The purpose of savings is basically for emergency and your short-term goals. Investing is basically to build your wealth in the longer term. Your return will be very low, between 0.1% to 3%. Meanwhile, for investing, your return is probably higher, between 6 to 10% average over time. And of course, the risk for savings is close to none, right? And investing, there is a medium to high risk depending on the asset classes that you choose to invest in. Oftentimes, savings will lose out to inflation. There are times that savings would beat inflation. This is a reality, but most of the time it will lose out. And then, of course, investing, the idea is really to beat inflation. And of course, the access for savings is basically very simple. I'm sure most of us, by our age at this time, will probably have already put in some monies into your bank accounts and stuff. So meanwhile, investing will probably require a bit more time to grow it. And you probably need to look at the various platforms that are available to see which suits your type, right? So the idea is that savings give you that safety emotions, right? Meanwhile, for investing, is something that require patience and discipline. So wealth is basically about building through the assets that you have in order to grow, right? There are some asset classes that you can really invest into, stocks, ETFs, REITs, property business. These are just some of the examples, which I will explain a bit later on. Now, but the idea is that you don't have to be rich to invest. A lot of people misunderstand that, when I have a certain amount of money, then I will start investing. And I think this is a misconception. The idea is really saving is step one, investing is step two. And you don't need thousands, you just need consistency. Now, investing is how everyday people can build their wealth over time, right? It's about that long-term growth. So if you can see here, it's about you earning your income, right? And then you're saving it, and then set aside certain amount for investing, and then repeat that cycle until you grow that wealth. Now, just give an example how the rich build their wealth. So this is a very popular person if you have been following investing. Warren Buffett is known for long-term investing. This is one of the quote that he talks about. If you don't find a way to make money while you sleep, you will work until you die. And I think that's very true. I think one of the favorite movie that I watch, I think it's Wall Street, that talks about money never sleeps. And I think it's very important because the only thing that can work for you while you're sleeping is money. And you need to make sure that you maximize and allow money to work. So you can see from the image here, now, the person on the left side is actually those who work from 9 to 5, which is good. I'm not saying that it's a bad thing to work from 9 to 5, but basically you are basically just using your time to create money for you, right? To get the salary that you require. Meanwhile, if you look at the person on the right, is basically investing. So even when he's sleeping, his money is actually working for him. Now, the wealthy focus on assets, not just salary. Like I said, a lot of times from 9 to 5, 9 to 6, when we work, we are basically using our time to grow money, to have salary in order for us to pay our bills and stuff, right? Meanwhile, asset, the idea is to build wealth. So the wealthy actually focus on owning things that can grow. Businesses, stock markets, real estate. So that's what they're focusing on. So the secret is really not luck, it's about time and ownership. So just in case if you don't know, Warren Buffett started investing at a very young age. So if you think that you are young today, he started at an even younger age than you are today. Most of you are already in your uni days, right? So he started even at a younger age than you. Personally, I started investing when I was 19, right? So I've been investing. I'm already 37. So I've been investing for over more than 10 years. So I think that's where you realize that actually, in fact, it is how early you start to invest that actually makes that is the key differences, right? So you allow compound interest and invest in good companies that actually that helps to grow your wealth in the longer term. I will talk a bit on compounding interest, right, later on. If you have questions, just put in there, in case if I overlook it, right? In terms of the secret is really ownership of growth, right? Warren Buffett does not make money by trading daily, right? Not a lot of people make losses when they try to trade or time the market on a daily basis. Only a handful of people that can actually make money from trading. That's the reality of things. But if you talk about investing in longer term, right, I'll show you the data later that most people will actually make money if they were to invest in the longer term. So there are companies that Warren Buffett owns, companies like Apple, Coca-Cola, American Express, companies that he holds for years in order to grow that wealth. So the idea is really about buying great businesses, holding them long term, and let the compounding do the heavy lifting. Now, I talk about the secret, time and compounding. So what does that mean by compounding interest? So basically, compounding is basically you're earning returns on past returns, right? You're earning interest on top of interest. So the earlier you start, the better it is, and every small amount grows bigger given time. So this is the chart. If you look at the chart here, you can see there are three people that I give as an example: Anna, Ben, and Chris. Now, each of them actually invested the same amount of money in the same amount in the same index, right? I'm assuming that it's just 10% return over the period that they're investing and on an average. So Anna started at age 20, Ben started at age 30, and Chris started at 40. So if you look at the key difference is that Chris, who started at 40, 20 years later than Anna, actually saw the growth significantly lower than what Anna has. Look, Anna started at the age of 20, he would have about 638,000 by the time he reached 65 years old if he were to put in just $100 every single month. But if you look at Ben, started just 10 years later, it's about, I think the money is about more than close to 3 times more than what Ben is getting. So it just shows you that time in the market matters more than trying to time the market, which I'm not saying it's not important. It's just that it's probably not as important as you starting it. So the idea, if you have not been investing, is not about when to start investing. You should start today. The best time to start investing is yesterday. The second best time to do so is today. So if you have not do so, it's probably start to relook at some of your money habits so that you can allocate some of the money that you have into investing. All right, so what you can invest in, I think I talked about asset classes earlier. So these are some of the asset classes that I wanted to just share with you guys. It's just some samples, things that are easier for you, and of course, a bit more relatable to your ASEAN investment challenge. So firstly, cash and deposits, I think these are important. This is safe, low return, but before you can invest, I always believe that everyone should grow a certain level of emergency fund in their portfolio. So I think it's important to have that. So usually I would recommend 3 to 6 months of their basic expenses. So that's how I would look at emergency fund. Aside from cash, then you have your stocks. So a lot of people look at stock market as a ticker, right? They look at this price go up and go down, but really stock market is about ownership in a company. And a lot of people miss this. It's about buying companies that will do well over the next 5 to 10 years or 20, 30 years down the road. So it's about building that stakeholder that you have in certain companies in order to gain the benefit of it. So why businesses? Because so when I was young, I realized this, right? I talk about inflation. I realized this, the only thing that can actually beat inflation is really business. I mean, of course, there are other speculative tools that you can go to pursue, but those are things that come with risk. But business is the one that really beat inflation because business move along with inflation. Whenever there's inflation, business owners will increase prices. I mean, sometimes they do absorb the cost, but what they do is that they pass on some of the cost to consumer. And they're the first to be able to pass on that inflationary price to consumer. And that's why I always think that business is the best investment that one should go into. But not everyone can do business because a lot of times we have our own interests. For example, some people might want to be a doctor, right? Some people want to be an artist, for example, right? So you have different interests that you want to do. So not everyone have that time and capacity to do business, or if you are a student, you probably don't have that time to do so. So the next best thing is really the stock market because it allows you to own a fragment of the companies and gain from the benefits of the companies through the increase in terms of the valuations, dividend, and other methods, right? So that's basically what stock is. Then, of course, there's ETF or index funds. So basically, these are just a basket of many stocks. So ETFs are the ones that usually come with lower costing because they just track on certain benchmarks index. So there are a lot of different indexes in the market that track, for example, the Singapore market, there's the Straits Times Index that track the Singapore market. The Malaysia, there's the FBM KLCI. So there are various benchmark that do so. So these ETFs allows you to really invest in all these companies that are part under this basket of stocks. So it's easy to start investing through ETFs because it allows you to have an instant diversification. So when you buy the S&P 500 index, right, you automatically have all the companies that are within the S&P 500 universe. Then, of course, there's also REITs. REITs are basically real estate investment trusts. It's basically a trust fund that invest into properties, and then they allow different shareholders to participate in that investment. So basically, you are a landlord, but instead of owning the entire building or the entire shop, you own a fraction of the units, right? So then this REITs will eventually give you back dividends. So there is a plus side to a REIT structure. These are a bit complex. I mean, you probably need to read it up because it has to do with how regulation works. So these REITs actually benefit from some of the dividend incentives that they have. So their Singapore market is very known for their REITs. So this is some of these asset classes that you can consider. Then there are also dividend stocks. It's basically just stocks, but stocks that give you dividend on a consistently basis. Right. So there are other asset classes. I think you guys are probably very familiar with things like crypto. So those are asset classes that are with higher risk, or your commodities which come with whether it's gold or it's oil, whatever. There are investors who are more savvy. But I think people who wanted to start will probably wanted to look at the ones that I've just talked about, right? Basically, I call this the asset class 101, basic for investors to have a quick understanding on what it means by asset classes. Right, so knowing the different asset classes, then this is where you will meet your, I called it meeting your superpower, fractional investing. I think in the past, there isn't any fractional investing platform available for a lot of people. There are very little. There are ETFs that you can do so, but nowadays there are a lot of platforms that allows that. I mean, if you're using US Robinhood, I think CGS, we ourselves, we have UP, which allows fractional investing. So basically, you can actually afford to buy a fraction of a single company. So for example, if you like Microsoft shares, but you don't have the amount of money to buy 100 lot, for example, 100 units, right? So what you can do is you can just buy maybe 0.05 of it, right? You can just buy fractional. So instead of buying one share of $500, you can just invest $10, right, into fractional shares. So this allows you to get started very quickly and allows you to own companies that are well-known, like your Apple, your Tesla, your Nvidia, DBS, Netflix, and the likes, right? With whatever that you can afford. I will talk about how this will come in handy later on, because it's actually quite important for you to test try some of the things through fractional investing. Of course, I think the downside to fractional investing is that the cost would probably be higher if you were to invest $10 every time rather than investing maybe like $1,000 or $500 at a time, right? So usually what I would encourage people to do is that for longer term investors is that when you started off, start with this year and then invest on a regular basis, like maybe 6 months time period, right? So how you're going to start is simple. Start with ETFs, like I talked about it. You can actually build your portfolio automatic with ETFs and then set it into an RSP. RSP basically means regular saving plan. So it allows you to invest into the market periodically, like I talked about. So I'm just going to recap a bit. What are some of the benefits with ETFs is that it provides you with instant diversification. It's lower cost, and it also allows you access to global markets. So you can basically invest in US, whether it's ASEAN, it's China, Hong Kong, whether it's you wanted to invest into gold, even crypto, I think there are some of those as well, all via ETF. So it allows you that liquidity and flexibility, and it's easy to start without having to be a good stock picker. So for people who just wanted to start off building a portfolio, I think ETFs is a very good way to start. And then from then on, you can start setting it up into a regular investment plan so that you can start making your investment automatic and growing it consistently, right? So what's the benefit with RSP aside from allowing it to grow on an automatic and consistent basis is that it takes emotion out of investing. I think one of the downside to investing is that a lot of people get panicked very quickly, or you get FOMO very quickly, because for example, if share price were to drop 30-20%, a lot of people become very panicky, right? People become very afraid of things, right? So this allows you to basically take advantage of the dollar cost averaging, right? So when prices fall down and if you continue to invest, this allows you to buy shares at a much lower price. So I'll just give you an example. COVID-19 pandemic is the most recent recession that we have, and it's the fastest recession that we have seen over the last 50 years. I think in our history, actually, yeah. So it actually only lasted for about 2 months. Share price tanked like 30+%, but then it recovers like, I think it's close to within the next 3 months or so. But it's not always like that, right? It's not always that when it tanks and then you will recover. But COVID is that pandemic was a period where it recovered very quickly because governments spent a lot of money to help to support the economy, because a lot of shops were closed, factories were closed, nothing could be done. So the economy were affected very badly. So all the governments actually spent a lot of money to boost the economy. So that's actually helped, right? But what I'm trying to point out is that if during the collapse of the share prices, and if you were to consistently invest in a disciplined manner, not allowing emotion to come in, you would actually buy at a cheaper price rather than selling it at a loss. And it goes the same with during Trump's first presidential election or during his second presidential election that we have seen so far, right? We've seen the first election when he came in, he talked, the share price dropped for very sharply for a while before it actually rebounded back in his first term. I think if you look at the second term that he has, on April 2nd, Liberation Day, the US called it, right? Trump announced all the tariffs that they imposed into all the different countries. Share price tanked immediately, right? But then the US administration later on backtrack and say, oh, there will be a truce and all that. So share prices actually recovered. So what I'm trying to tell you is that yes, RSP allow you to avoid having all the emotion when reading all these headline news that are that could appear to be quite scary at times, right? So is it the same for all markets? Like, does it guarantee you to invest and then you will definitely gain money from investing? I'm just going to show you, this is, unfortunately, Philippines is not inside here, so my apologies, because when I do this, Philippines was not under my coverage. So what we look at is that we look at half year return for this year, and then we look at 1 year ago, the last 5 years, and of course the last 10 years. So if you look at the last 10 years data, if you compare US, Europe, Asia, you will notice this thing, right? That US actually far outperformed the rest of the market over the last 10 years. These are driven by a lot of factors. Some of it is because of the monetary policies in US. Some of it is because of the tech growth in US. So this has actually helped to drive the share prices for all the tech companies in US. So you look at Nasdaq grew by 400+% over the last 10 years, significantly outperformed the rest of the market, right? But the US alone actually still also outperformed the rest, right? But if you compare that to if you compare that to the first half year of this year, you'll notice that US market underperformed significantly. While it's still a gain, right? You can see S&P 500 gain about 6%, Nasdaq was about 8%, but it actually underperformed Europe. Like, for example, the Europe Stocks Exchange was growing at 11%. Germany DAX was at 20%. Hong Kong Hang Seng grew about 22%. South Korea Kospi grew close to 30%. Then if you look at Singapore market, it grew about 12%. So the US market has actually underperformed a lot of the markets in different regions. So these are some of the things to take note of, that the market doesn't move in a linear direction. So it will be affected by a lot of variables, which I will talk about it later on some of the factors that drive the market movement. And then if you look at Thailand market, for example, SCT, that's the stock exchange of Thailand. It's actually saw a decline in the first half of this year by about 20%. This is the total return. And the last 10 years, it actually saw a slight dip. Part of this is because Thailand is struggling with so a lot of political uncertainty. So this has actually affected the market a lot. So if you're investing in the Thai market, so you are probably more familiar with the political environment in Thailand. So you probably need to be a bit more savvy in terms of your stock picking, because then you can't just rely on the benchmark and invest across all the leading companies in Thailand, because the market is very fragile at this point, because there's a lot of uncertainty on the political front. And you look at Hong Kong as an example. Hong Kong this year has done very well. It's a strong recovery this year. In the first half, you can see that Hong Kong is the Hang Seng Index, if you don't know, right? So it grew about 22%, 22.9%. And if you compare that to 10 years ago, the last 10 years only grew about close to 31%. What this means is that the last 10 years, the Hong Kong market has been very lackluster. Now, this is because of a lot of the uncertainties, again, on political ground in Hong Kong, right? So those are things that people are not sure whether Hong Kong will still be the financial hub. There's a lot of uncertainty, how it will look like with China coming in and stuff like that. So these are things that really affect the Hong Kong market. But of course, this year, I think that China has a lot of stimulus that helps to support the economy. Aside from that, there's a lot of Chinese from China that actually invest in Hong Kong market through the southbound flow. So this actually allow the Hong Kong market to do very well. And of course, you look at South Korea, it grew by 30%, but the last 10 years actually only grow about 80+%. So the last 10 years for South Korea is considered decent market, but it's not a very strong market either. But this year is doing very well because of a lot of fiscal support that the government is pushing out. So what I'm trying to tell you when I show you this is that various markets have various opportunities. So you can't just look at your local market, or you can't just look at the US market, because the US market is always hot, right? You need to look at a lot of different factors that are driving some of this money flow into various markets. So one way to look at it is through reading a lot of the news flow, of course, that's one of it. Another is really to get in touch with companies, big companies in each of these markets, and read through their earnings guidance, look through their financials, read through some of the commentaries by the management. What are the risk factors that they're looking at? So whenever government talk about announce, for example, their quarterly GDP growth numbers, Singapore just announced one of it, right? Their second quarter. So while the second quarter is doing quite well, I think Singapore is expecting the economy to actually slow down in the second half because of the tariff. That's one of it. A lot of the exports have been driven by front loading in the first half. So the consensus, the market view is that the economy in the second half will actually slow down a bit. It will still be a growth, but it will be a slowdown from 4% level to a range of 1 to 2%. Right. So for investors to start off a beginner portfolio example, this is basically how I will do it. And I would encourage and I would advise investors to go through a similar I would call it a philosophy or a similar style of investing. Basically, start with strong, stable companies. What I meant by strong, stable companies are companies that have strong brand name, companies that have strong cash flow, companies that are well known in your specific market. I always, while the stock exchange Thailand was not doing very well over the last 10 years due to a lot of the uncertainties in the market, but if you're in Thailand, I would advise you to start your investment with your market because you are most familiar with your market. Always invest in things that you know rather than things that you do not know. So look at companies that are in the consumer staples. When I talk about staples, it means companies that do food, snack, toiletries, stuff like that, because these are things that people will still buy and use despite whether it's a downtrend or recession or whatever it is. People will still invest in things like that. Next one is healthcare. Healthcare is when you're sick, you still need to go to see the doctor, right? It doesn't matter if you are sick or well, right? Then, of course, healthcare, there are two types, right? There are hospitals and then there's also biotech. Just to give a bit of context, biotechs are companies that come out with more innovations and medicine and stuff like that. So biotech companies have a lot more risk, right? But it's also a lot more lucrative. So when you look at biotech companies, always look at the leaders because usually the leaders are the first one to come out with groundbreaking results. So for example, Pfizer saw a big boom during the COVID because of the vaccine, right? But it's not just the US have biotech companies. In recent times, if you look at just now, the Hong Kong market did very well. One of it was because the biotech companies in China are doing very well now. A lot of investors are interested in it because they have advanced a lot. So these are things that you need to look through and read through to understand a bit deeper, right? But if you don't have time, just go for the safe one. Look for things that allows you to hospitals that consistently deliver, right? Or even the more common names like Johnson & Johnson in the healthcare industries. Then utilities, basically your electricity, your water bill, green and renewable energy, things like that. So these are those that you probably will benefit from. And of course, your banks. I think banks have also, aside from the growth that they have, banks also have a lot of usually they tend to give a decent dividend yield that could help you to your portfolio to be more balanced between growth and dividend names, right? Then of course I added one that is solid tech names. I think we are living in a time where technology has become very important in our lives. So it is impossible to say that we don't want to have any technology names in our portfolio just because the valuation is high. Of course, valuation is important, but it is important to look at tech names that are solid, that offer you a value at an attractive level. So I'll just give an example, right? I'm not sure how many of you are familiar with Microsoft, but if you are, then you when you look at the news, I think it was the last 1 year, there was a virus attack that hit CrowdStrike that actually affected Microsoft solutions. And it actually affected a lot of businesses, whether it's aviation, whether it's small businesses. So a lot of these businesses use Microsoft services because Microsoft strong business is in the B2B, business to business segment. So a lot of businesses were affected and a lot of system was shut down. It just shows today in our age how relevant it is for tech companies in our businesses. When their services are affected, a lot of things cannot work. So I just want you to know how important, how embedded are some of these things in our ecosystem that it's actually impossible to rule them out, right? So aside from this strong and stable company names that you have, another thing to look at is to add one or two ETF. So for example, if you are already, your investment portfolio is already very heavy in your local market. Say for example, my investment portfolio maybe is very heavy in Singapore market. So what I do is that I probably add one or two ETFs in maybe like US and Hong Kong market that allows me to gain exposure in a growing market. Or even for example, India market, which is one of the fastest growing market over the last 10 years as well. So then just add one or two dividend stocks in order to grow the income of yours. And I talked about fractional shares earlier. This is where it comes in very handy. Use fractional shares to experiment without big risk because you can buy a little bit of it and then you can see whether it is something that suits you, right? You look at the performance of it and then you can start analyze about the companies. So fractional shares allow you that flexibility because you're not putting in a lot of money and your stakeholders in it and your stake into it will be very little. All right. Now that I've talked about all this thing, let's just talk about the basic investment strategies. But before I go there, let me just take a look at the chat. Let me see if there are any questions. Right. So what type of investment that you will never invest in? So I think for the investment that I will not invest in are basically investments that I'm not familiar with. Say if I'm not aware of, I don't understand how crypto work, for example, then I will not invest in cryptocurrency. It's not that crypto is something that I must not invest in. I'm just saying that because I don't understand it, I won't touch it. It's very simple, right? The same goes for you. If you before you invest in any asset classes, it's important for you to understand the values that it add to not just to your share, to your asset classes, but the values that it add to the community. So the way why share prices across the stock markets, why is it move up and down? It's basically because the value that this company bring to their shareholders through the earnings growth that they have. And because why the earnings growth? Because people buy into it. So for example, why do you want to buy a Tesla car, example, right? Because there's value to it, right? You find the value in buying into Tesla, for example. Or why do you want to buy an Apple, right? What an iPhone? Because there's a value that you find in it. It's easy to use or whatever the reason is, right? So those are the values that you look at. If a company or an asset classes do not add that value into it, then there's no point to invest in it. That's how I see it, right? And then I think when people start out to invest, they tend to observe the market on a daily basis and get worried. How do you prevent these kind of thoughts to get to you? So I think it's unavoidable. I think that thought will always be there because I wouldn't, I think a lot of people thought out of sight, out of mind, right? I think it's also a bad thing. Some people just didn't want to see it because they are afraid of it. I think the idea is that you need to balance yourself. That's which is why when you build your portfolio, it allows you, once you have a stable set of portfolio, say you have 60-70% of your portfolio that's already stabilized, and then you have set aside maybe 5 to 10% to trade or to monitor based on certain trends or market thematics. So then you are able to be more confident in that approach because you know that you are stable. You're only investing that 10% that is you're trading with, right? So that allows you that mindset to not worried about losing money so much. Invest before or after the tariffs on 1st August. I'll talk about that later because that will be the slides on bonus round that I talk about. How often do you mean by trying to consistent with investing? So I think I talk about this. I think for me personally, I think every 6 months will be a good time period. If you think that every 6 months is a bit too short, then probably every year. I wouldn't recommend every 2 or 3 months or so. I usually recommend 6 months because it allows news flow, it allows developments, it allows earnings to be reflected in the shares as well. So that's when I will usually make my decision. All right, let's just talk a bit of the basic investment strategies so that you guys can get started with your asset investment challenge if you have not started, right? So the first thing is really value investing. I think I talk about this, buying great businesses when they are undervalued. So it's actually very difficult to talk about undervalued stocks sometimes because there are reasons why stocks are undervalued most of the time, right? Why share prices tank is because they are bad news most of the time, right? Because there are things that people don't like. So usually share price would come down, or there are big headline news that affect, say, certain industry. So usually stocks that are trading undervalued is because investors are afraid of it. But having said that, in the longer term investing, you should practice this because this allows you to buy companies that have great fundamentals at a value that is more fair, that is value that is better than rather than you are buying it at a high or at its peak. So basically, these are some of the key ways to look at it. Look for stocks that are trading below their intrinsic values. So when I say intrinsic values, basically means their fair value, right? So again, the fair value is very subjective to everyone, right? So these are usually based on certain metrics like your price to earnings ratio, your price to book ratio, or your cash flow or your dividend yield. So these are just some of the things that you can look at. So this often includes mature companies that are temporarily out of favor. So I'll just give an example to you guys. If you look at I think Microsoft back in I can't remember when was the year it was in, but during Ballmer's time and Steve Ballmer was the CEO, Microsoft share price actually underperformed a lot because there is not much growth direction, but the company's earnings have consistently delivered. It's still outperforming, but in terms of share prices, it's always underperformed the likes of Apple and others at that time, right? Until Nadella came in and then reject the company's direction to focus on some of the growth channels like your cloud and your data centers and AI. So, but what people don't realize, which I think, while I don't like Ballmer's direction, but I think this is often not presented, is that Ballmer helped to establish Microsoft business, embed it into a very strong ecosystem, so much so that most businesses cannot survive without Microsoft. So that actually helped Nadella, the next CEO, to came in, and when they pivot his direction, right, he's able to expand and scale the business at an accelerated pace. So I'll just give an example. Over the last 30 years, right, Microsoft has consistently been on one of the top 3 or 4 in terms of valuation, right? One of the top 3 or 4 most valuable companies. These are because of this direction, right? But at certain time during those period, there are times that the company undervalued. So those are times that you can actually look at and invest in it. So what you really do is basically you compare the price earning of the company at that point of time, compare it with its historical average, and then you'll be able to see whether it is underperforming or is outperforming, right? So just a bit of explanation what price earnings ratio is. This is going to be a bit dry, right? So basically PE tells you how much a company earns for every dollar, right? Of how much you're paying for a dollar of a company's earnings. So a PE of 10 means you're paying $10 for every $1 that the company is making. Basically, it means your price divided by your earnings. So the lower your PE is, the better it is in a way, right? Because it's cheaper. Basically, it means that it's cheaper when the PE is lower. Then when you look at price to book, basically it's comparing your stock prices to the company's asset. So basically your price divided by the book value of the company. So a price to book value of 1 means that the stock is priced equal to what the company is worth. So in general, lower price to book means that the company is cheaper, right? So what about cash flow? So I think cash flow is very important. And I think a lot of companies, a lot of investors look at cash flow when they talk about growth companies, because they want to know how much real money a company brings in from its businesses. So basically, cash flow, you can think of it as how much a company makes after all the expenses, right? So more cash flow generally tend to means that there is a stronger ability of the companies to pay off their debt, to continue to invest in growth, as well as to return money to shareholders through dividend. So those are things that investors can look at. Next one is basically growth investing. Basically, you want to buy companies that are growing fast and leading their industry. So these are tech companies most of the time. So you're looking at companies that invest in the next innovation. For example, your biotech as well. So a lot of times when you look at companies, when you look at growth investing, you look at revenue, you look at earnings growth. So these are often in whether it's tech, consumer, or even innovation sectors. The risk is of course higher, but the reward is usually higher as well. So some of the examples are your Nvidia, Tesla, and Palante. Now I'm just gonna take Tesla as an example. Tesla is a growth company that is trading at a very expensive valuation. But of course, share price has come down quite a fair bit due to some of the political involvement of Elon Musk. But why share price is trading at such a valuation is because Tesla, under the guidance of Elon Musk, always focus on things that are the next growth factor that will drive that will change the industry. So Tesla has just launched their robotaxi services. Basically, it's an autonomous car service. So what it means is that you can actually order a Tesla to fetch you that is not driven by any people. So it basically Grab, but it's automatic, right? So if this were to become commercially viable across different regions, then it will help Tesla to boost its earnings, and it will give a lot of growth potential for the company. Now, what is the difference between Tesla and others companies when it comes to autonomous vehicle is Tesla rely very little on hardware, rely a lot on software that allows the company to scale at a much faster pace if they can do so. Because when they do so, they don't have to invest in all the expensive hardware, and they could actually utilize a lot of the older vehicles by just updating the software. It's basically like your phone, updated it to the latest software that allows it to go automatic. So that's why there's a lot more when you look at valuation, Tesla is probably at a more expensive level. Now, next is dividend investing. Basically, you want to buy companies that pay you dividend while you wait. So basically, these are companies that are stable, cash generating companies, means you can earn regular income through dividends. So these are usually popular for people who wanted a stable income or for long-term investors. So you look at another thing to really look at is dividend growth. So don't just look at companies that give out consistent or similar dividend on a yearly basis. Look at companies that are able to grow their dividend in the long term. So these are companies that we call, like, for example, Coca-Cola, Pepsi, P&G. All these companies have grown a lot of their dividend over the last 50 years. So it's not the last 10 years, it's the last 50 years. So that's the track record that we are looking at, right? Then invest in moats, buy companies with lasting competitive edge. I think it's very important. So what's economic moat? It basically means the company's long-term advantage that protect it from its rival, right? Basically, it's like a moat surrounding a castle. This is a very famous term used by Warren Buffett, which I'm just basically copying. Right, just gonna give you guys some example, some of these investment modes so that you understand what I meant. So if you look at NVIDIA, why is it so popular with the AI space? It's not just because it manufactured GPU. It's because the GPU and the AI chip space that they are in and the ecosystem that NVIDIA used to lock customers in. So basically, a lot of the GPU that you are seeing today will have to rely on the ecosystem that NVIDIA has. So it's not so easy to replace them per se, even though if the likes of Intel or even other chip makers can come up with a better GPU or alternative. Then there's Microsoft, like I talked about it earlier. The idea is that a lot of these services are already very embedded in businesses that's very hard to switch. Then if you look at in Malaysia, there's Public Bank. I think if you're from Malaysia, then you know Public Bank has a strong record in terms of trust and a very lean cost structure. And then DBS is the digital banking leader in Southeast Asia. Singtel is a dominant regional telco player. For CPO, actually they own 7-Eleven, I think in Thailand. So they have the largest retail chain and it's very hard to replicate that for other competitors. Then PTT Group is an oil and gas supply chain that has from whether it's from upstream all the way to retail. So this gives them an edge. Then in Indonesia, there's Bank Central Asia. So it's a leading private bank with a wide reach. In Philippines, there's SM Investments, which have a massive more footprint and logistics dominance. So look at companies that have this modes that allow you to grow in the longer term. All right, let me just take a look if there are any questions. Okay, this one on the platform, I'm gonna skip. A lot of people throw money into their investment portfolio money. Thoughts on it? I think that's fine. I think it really depends on individual. I don't think there's a right or wrong investment. It's just personally, I prefer to allocate it on a 6 months basis because I think that that allows the share price, if let's say there's a rally, it allows share price to move. It allows you to look at it before you can rebalance your portfolio. Or you will also be able to see when share price will come down a bit, right? So on a monthly basis, it's also okay if it's something that you prefer to do so. Right. When I talk about bonus round, it's basically just to tell you what's happening in the market recently so that you can actually plan and strategize your investment if you wanted to. Because I think ASEAN Investment Challenge, the downside to this is that it's a very short-term trading challenge. So basically, you have to be able to make a lot of money through this period of time. So you probably need to pay attention to some of the key developments that is happening globally. So the first thing is news-driven market and Trump tariffs. I think there's a question on whether to invest after or before the tariffs on 1st August. So I think markets are reactive, especially to trade headlines and tariff policies. Now, unfortunately, I don't have a crystal ball. I wouldn't know whether Trump intend to impose tariffs or not. But I think that it really depends on what news flow that is coming out from the Trump administration, whether there will be trade deals or not. So I think when you look at it now, we have a sense of how the trade deal is going to look like. Basically, most companies are going to have at least the 10% tariff, I suppose. And then, of course, there are some countries that will be imposed with higher tariffs. So we will see which countries will benefit from it. At this point, Indonesia has one of the lowest, aside from Singapore. They have 19%, so it's lower than what Vietnam has and what Malaysia has. So this could probably give them a long-term advantage if this were to remain in place. But it's something that we need to see further. Now, basically what you need to look at is you need to look at how the announcements are coming out. So US companies will definitely react to these announcements. So you go through the earnings and commentaries by some of the CEOs and management. They will tell you about how the tariffs will affect the consumer prices, how inflation will look like. And then, of course, how they will spend their capital, whether companies will continue to invest or not. I think those are things that we need to look at. So, for example, if you want to invest in NVIDIA, you need to look at see whether companies are still investing on capex to build their AI functions and capabilities. If they are, then NVIDIA will definitely benefit from it. I mean, for example, you can see how news flow is driving the market, right? When Trump announced that NVIDIA can actually resume the sales of the H20 chips to China, share price for NVIDIA actually rallied, right? So some sectors will benefit from it, others will suffer. So, for example, steel will benefit from it if there is a tariffs on steel imported from overseas. So the steel makers in US will benefit from it. So if you look at auto sectors might be affected if this were to be in place. So you basically need to look at how the market moves, because a lot of this will be very news driven over the next 2 or 3 months. So I think this is the period where you'll be involved in the ASEAN Investment Challenge. So you probably want to keep an eye on it. So what to watch for? You need to look at the trade policy and tariffs. Expect more volatility with any headline or delays. One way to do so is basically I followed Trump's Truth Social because that's where he first announced his news. So then you'll be able to have the first news compared to the rest of the world in a way, right? Then, of course, central banks in ASEAN are expected to ease policy to support the economy. So you need to see whether this is going to materialize, because when central banks cut policy, it helps to actually lower some of the borrowing costs. So earnings for companies could actually grow. So these are actually good news. Then you probably need to look at economic data and earnings. I think talk about Singapore earlier. Then there's also some global geopolitical flashpoints that you need to look at, because any tensions in key shipping lanes could actually affect the supply chains and energy prices. It's very important because we are in an era where we call it the Great Reset. I think all the supply chain will probably be some of it will be restructured. So you need to see which countries will benefit from it in order to make your investment decision, especially during this period of time. Right, so some US earnings updates. So if you are looking at investing in US, so the earnings have come out pretty decent. I think the banks are the first to kick off their results. So far it's quite good because it's actually supported by strong loan and consumer spending. It's also very important because what we saw is that a lot of the results were quite good because of the trading activities in the market that have increased. So market may be stabilizing despite of the macro uncertainty. So I think one of the reasons is because of the Trump tariffs, so there's a lot of trading activities, buy and sell activities among traders and investors. So for AI and tech, so you probably wanted to look at how earnings guidance going to look like. AI demand is likely to continue to power growth. So I'll basically show a simple way to look at it later. So look out for these earnings updates in order for you to see whether earnings can beat the expectations. When I talk about expectations, it's very important, because most of the time share prices will go up if, let's say, if the companies deliver an earnings that beat expectation. If they underperform, then they probably will see some decline in their share prices. Or if you look at guidance as well, if the guidance is good, then probably investors will be more positive of the company. So go through that time to read through some of these earnings updates. So this is just basically the earnings expectation. You can see tech, communication services, financials are all in positive, right? So banks have actually outperformed this 3.9%. Then if you look at consumer staples, real estate, industrial materials, consumer discrete, and energy, there is expectations of a decline for this coming quarter results. So just to let you know, despite the underperforming global markets, right? As you see earlier just now, the US actually underperformed the rest of the market. The S&P 500 is actually still trading at a very high valuation. So this is a chart that actually shows you the PE value at this point versus its average. So you can see that it's higher than its average 5-year and 10-year PE. So, but of course, it's still far from its highest level over the last 2 decades, but it's still trading at a pretty high level, meaning that the investors are pricing the market to perfection. So a lot of the tariffs fear are not priced into the market yet. Now, for those of you who wanted to know some of the different economic strength for the different markets, so this is just a snippets of it. So for US, it's basically consumer spending strength. Why a lot of people are afraid of US tariffs is because US consists about 33% of global consumer spending, right? If you look at Singapore, people are expecting a rebound in services and digital economic growth, financial hub with your DBS, your OCBC, and UOB. And then there's also selected green infra spending that is expected to boost growth. In Malaysia, it's a lot of domestic demand. E&E exports could be affected by the tariffs. Then there's also strong construction pipeline and a potential recovery in tourism. Indonesia is also similar. Domestic consumption, infrastructure push, interest rate cuts, which are supportive of growth. In Thailand, it's a bit difficult. It's a bit challenging to notice what's the trend to look for. But recovery in tourism is one of those that we are looking at. And then, of course, we want to see how EV and semiconductor manufacturing investment will play out. And of course, the major public construction projects will go. So these are depending on some of the policies that are in Thailand. And of course, Philippines, the remittances back to their country will usually fuel consumer spending. It's a young population. And then, of course, the transport and infrastructure modernizations are things that we will look at. Now, for US thematics, if you're looking at, so you can consider looking at Trump tariffs. It will be very important. It will continue to play a part. The taco trade, they call it Trump always chickens up. Basically, whenever there's a bad news, share prices will tank, and then it provides you an opportunity to buy the dip. So the next few series, we'll talk a bit more on technicals on how to monitor some of these opportunities. Then, of course, the Thai bar that is set by the tech companies. Then consumer is basically split. I think staples, some of them have the pricing power is fading, but some of those, like for example, Nike has those with strong DTC direct to consumer brands have actually outperformed in their latest earnings. So you can actually look at that, right? Discretionary trade will remain exposed to tariff risk. So your luxury goods and all that might still remain risky to some of the tariffs that Trump intend to impose. Then you have energy weakness. I think this will consistently looking at how oil prices going to be, whether there will be more supply coming from the Saudi, from the OPEC side or not. So those are things that news that you probably wanted to keep an eye on. Then I think the macro crosswinds that come across, whether it is US Federal Reserve, what are some of the things that they're going to do, whether they will cut interest rates or not. And bear in mind, 41% of the S&P 500 companies have their revenue come from overseas. So this means that global demand and Forex will have a play in terms of how it affects the earnings and all that. Then, of course, your weaker USD could actually help exporters. There is a risk in terms of inventory after all the front loading. So these are things that we wanted to take a look at as more data are being reviewed. Key thematic plays in ASEAN, Asia, right? You can look at construction and infra boom. Domestic demand is one of the things that we talk about a lot. So you look at companies that have strong domestic consumption and depends more on domestic rather than rely on export. Recovery in tourism. So pay attention on tourist arrivals data, whether there is an improvement from that. Export risk consistently on our risk radar because of the tariffs. But take a look at Indonesia's trade deal. It's a partial win because they are one of the first to announce a deal after Trump sent out the letters. But this product, a lot of the products are still facing a 19% tariff. So the country remains vulnerable to some of these policy trade shifts that Trump has. All right, I think that's all from me. Let me just look at the questions. Do you prefer growth or dividend stocks? Should we be more conservative given current uncertainty? So I think it depends on whether it's a short-term play or a long-term play that you're looking at. And I think if you are looking at for the ASEAN Investment Challenge at this point, basically this next 2-3 months period, I think you need to balance out. Usually what I will do is I will make sure that I have at least, because it's a trading challenge, so you probably need to have at least 50% on growth, right? So that you can actually outperform your peers. So you need to look at whether the growth is coming from which market, whether it's coming from US or whether it's coming from your local market or your other ASEAN region market. So pay attention on that, right? But if you're looking at a longer term basic investing, then I'll probably advise investors to start off with 70% on companies that provide you with a decent dividend and value, because build up like I said, build up a stable portfolio that allows you to be able to take risks, right? Because at this point, when you are afraid to take risks, it might be harder because you are afraid of losing money, right? If you have not invested before. So once you build out a certain portfolio that allows you to feel more comfortable to take risks, then only you explore growing your portfolio into more growth companies. All right, I think that's about it. Don't see any more questions. All right, I think the next session, just to let you guys know, will be on how to avoid some of the key risks, basically how to manage risk when it comes to investing. So I'll talk about a bit more on how to allow yourself to have more exposure in growth counters while managing the downside risk, because I think this is important. A lot of people fail to realize that when you lose 10%, right, of your investment, you actually need to double, you need to gain back double of the amount in order to in terms of percentage, in order to break even. So it's very important to really manage that downside risk. Okay, I think that's it. I think, someone, shall we end it, or is there any other questions that? Okay, I think that's it for this round. Thank you everyone for joining. Appreciate you guys. I hope you guys have a good session. If you have any questions, feel free to just email us or anything. All right. Thank you. Bye bye.